Okay. Well, we're cutting it short, or cutting it tight like always. But it is Saturday, January 7th, and I have to do a financial model for this week. As you know, I try to do one a week. I'm really trying to get a good balance of industry models versus simple financial models that could be used across the board. So today's going to be an industry specific one, and it's going to fit my current situation because, well, as you know, if you've been paying attention to any of my other monthly reviews, I have, well, I'm in the process of buying a mobile home myself, all cash. Reason being, well, the bank wants 2 years of sole proprietorship. Um, well, they want 2 years worth of tax statements, or uh, tax returns. The problem is, not last year, but in 2015, I only made about 10 grand because I was just getting started. So this past year, I made 30. Now, if you average that out, it's 20 grand. If you take all my debt, basically they're going to say I can't afford a home mortgage. So I bought a mobile home outright in cash. Well, I signed the papers. It'll be moving in March. But anyway, since that's happening, I figured, well, why not model out what it's like if you were to build your own mobile home community and see what the revenues are like. So, as far as the start of that, now I have to go research. There'll be basic construction costs and all that the user can input, but then there's probably going to be specific costs related to this type of investment that I'll have to research. And then once I get all that, we can add in all the regular standard variables such as financing, um, and build some visuals. So I'm probably gonna do it for. It's gonna go to a max of 50 years because a lot of these parks are open for a long time. But then the user can choose how long they actually plan on holding the investment and what they plan to sell it for, and all that's going to be tracked with our IRR and return on investment. So anyway, starting off blank slate here. It's 5:27. We'll see how long this takes me, but I'll bring you back in when I get some more going. Stand by. And I forgot to mention, the plan with the mobile home is obviously I want to hold it for a couple years and then keep building my sole proprietorship business and track record. So then, in a couple years, I'll still have a nice cash balance to put down on the house, and the bank will accept me if I have a good track record with credit. Now, my credit score is fine. The issue is simply I need at least 2 years of income. So I'll try to obviously resell the trailer since I'll own it, and my costs are just going to go up. Well, about $900 a month when you include everything that's going to cost me. But that's my personal situation. But I thought it had some meaning since I'm going to do a mobile home model. All right, so here we go. Stand by. All right, guys, here we go. Well, there's a lot of financial aspects to this, but there's still a lot of good information specific to the mobile home park. I have included a lot of gold nuggets in here, little comments of insight based on industry experts, people who run mobile homes for a living. That's going to be helpful and available in the full paid version. So what do we have here? Well, you've got all your development costs. You've got land, construction, office, building, unit count. If you're doing new construction, you gotta add units to your lot or your land. Cost per each installed unit. The cost to fill the land with units, then populates. And actually, let me just show you. So let's just do, say, simple terms: $1,000 here, 500 here, 500 here, 5 units. Cost each unit is, say, 25,000. and now that all populates. Now obviously these numbers are going to be bigger, like 500,000 or 5 million. It just depends on where your location is. 500,000, 250. This could be like 100. So you can see how all that can change, and then if we're doing all of this, we probably wouldn't be purchasing a new park, so X that. Now here's the thing with these is normally, on normal conditions, it's going to be difficult to build a park from scratch and do all the construction. But if you have a vision and want to do something a certain way, and there's been expansion of population in a certain area, but it's, you know, it doesn't have some affordable housing options, you might be able to thrive there. Put a nice 50 or 100 count unit. If you're not doing that, if you're just going to go repurchase a unit that's existing, you just, you know, put whatever purchase price you think you're going to get it for. Let's say 2.5 million. There's your startup cost. Further down we got financing. If you want to finance a percentage of that startup cost, it'll go here. Then your initial cash outlay updates, your amount financed updates. You could put your term of the loan. It could be probably 30 years or less. Interest rate, payments per period. Then you're putting the first date you start the investment slash, well, this is going to be the first date cash flow. You expect cash flow to start. And then this is going to be the date you exit. You can go up to 50 years. And then your total time years is going to pop up there. You got your exit cap percentage. That's going to determine your sale price. So let's say your net operating income is $100,000 a year. If you're doing a 10% cap, that's going to value your park at $1 million. And you can see that takes this number divided by NOI. Say it's 100,000. Oops, sorry. That's going to take 100,000 divided by the exit cap. And that gets you $1 million in that scenario. So that flows through to the monthly, 50-year monthly and 50-year annual. Then we've got the year you're breaking even. Right now it's at 38. If I change the assumptions, let's say I finance less or more, that actually puts my break-even year out further. Let's say my initial cost goes down. Well, now my break-even year gets cut down to 24. Let's say we also change some of this. Let's put the lot fee up to, say, 290 for the first couple years. Then it raised up to 340. You've got unit count here by year. So this is year 1 to 5, 5 to 10, 10 to 20. So you could change all those assumptions on the year period if you have different plans for how you want to build it out. You've got background checks, just a small thing some places do to collect revenue because, well, you basically pay a one-time fee and you could do background checks, so it's like a revenue stream. Background check charge per person, and finally the vacancy percentage per year. So we got all that. Then we have our operating cost per unit, monthly maintenance. So let's say in each unit, if you take all the units, well, if you take each unit individually, you're looking at about $10 a month per unit. So about $120 annually times however many units you have. So if it's 50 units, or if say it's 100 units, that's going to be about $1,000 a year. And then we have administrative sales salaries. Now this is high here, 8,000, but it could be dependent on how many units you have to manage. 60 to 75. Let's say, I mean, this might be 4,000, but that's all your assumptions. You can play with yourself. Say it goes up to 6,000 at the end, and that's going to make a big difference in our break-even year. Probably it gets down to 6. So basically everything in yellow is what you would change. Then you've got your return sheet with an annual running balance, and we have our, here it's your total cash investment. Then you've got your IRR, which is taking the cash outlay and then going with what your cash does over the years. And that does take into effect the sale of the building at the given year you're deciding to sell. And if you don't sell, obviously you just make your sale date or end date longer than 50 years out, and then it would not be included. You got your total return on investment, which is the total cash, including the cost. No, excluding the cost. So this is just the total money coming in. 1,000% of your initial investment. If you take that annually, that's about 33%, and this is assuming this number of years here at 40.2. So if we change that, all those numbers would change. Now here's your net return on investment. So this is a little bit less. Basically, it's exactly $500,000 less because it's taking into account your initial cash outlay. So you got $6 million. That's still 1,200%. Annually, you're making a profit of $154,000, and that's saying you've already paid back this. So it's 31% annually, a return on your cash. So we've got a running balance. I need to update, and you see all this, everything flows through this 50-year monthly sheet, all nice and neat. And then we've got on the annual, we've done a running balance, but see, it doesn't stop at the end. So yeah, let's put an end to that. So running balance is if we're no longer owning this. So if this equals 0, then 0. Okay, that should be good now. So does it work? Yep, perfect. So now on our return sheet, you'll just see that final year, and that big number is the sale of the exit of the property or the whole mobile home. Basically, that's saying you've sold it. And then we've got an amortization schedule included. All the assumptions, all the main assumptions for financing flow through to this, and there's your schedule, and the model is automatically pulling the debt service, interest, principal, and the balance from that. And note that you will, if there still is a balance left when you sell, that is deducted. So let's say this, see if I did it in here. Oh shoot, let's go to the annual. So are we still borrowing? Yes. No. We're selling after the loan's paid off. Let's say the loan, though, say the loan's 50 years, so it still has a balance when we sell. That will take effect in the annual, as you see here. So you're actually paying back in this number, 1.6 million. You're paying back, and let's get the freezes on here so I can see what's what. So your balance is 950. You're selling it. Shoot. Well, here's one thing, and this is what happened when you first build a model. So this should equal that, not be summing it. Make sure everything else is right. So sale the park, yeah, that should be summed. Running balance is a manual here. Break even. Mortgage payoff. right. And that is only if. Stand by, I'll be right back. Alright, now we're talking. We got this thing going. So you can see on the annual, when there is a sale, the free cash flow before tax, it gives you the sale price less the amount you're paying off for the mortgage, and then less the debt service for that year. And you can see this is less because it's paid off halfway through, plus the operating income for that year, which that's less too, because again it was only it was halfway through the year or a couple months in. So that all works great. So save that and let's see what our returns look like. Didn't change a whole lot, but did change. And that's it. And remember, this running balance, this is basically your net cash. So you put 600,000 out originally. It takes you a couple years to break even, and then after about, well, what is it, year 6? So let's put that on here too, just to see. You can see that's gonna be year 6. After that, you're just making money, and that's you know, assuming everything goes great. But we have assumed, you know, some maintenance fees in here, which are based on the industry experts, what they've said. And you've got administrative salaries per month. You could also add in any other monthly costs that are here. Now, the other thing there is utilities and all that, but normally it's either going to be a wash. The mobile home park will charge you what it costs for the utilities, or you'll just pay for them directly to the utility company. So it's not really a revenue or a cost stream. If you just look at a broad picture of this, it doesn't really affect the returns that much, or the cash flows. And I guess that is the mobile home financial model. Now again, everything, all the logic is built here for you, so all you have to do is go in, scope out what you plan to do here in all the yellows, and then, you know, check out what the returns look like. Hopefully you enjoy it, and again, if you want to purchase it, you'll go to the description in the description box below this video. Well, if you're on YouTube, you'll go in the description box, click through the link, which will go to my blog where you can purchase it. If you are on the website, well, then you can see the purchase options right below. Hope everyone has a great weekend, and we'll see what happens next week.